All right, Albert.
Hey, Mr. Grider, how's it going?
Hey, good morning. I guess good afternoon for Rob. He's a little bit more on the different time zone. Man, it's great. Great week, right? And I've seen a lot of activity so far this year in the non-QM space. And man, we got this week is leading up to Sunday, right? Everybody knows what Sunday is, I think, right? I have a lot of relatives that live in Pennsylvania, and they're pretty excited, right? I actually live in Philadelphia too, a few of them. So
Right.
kind of interesting. But hey, welcome to February's webinar, and we're hoping we can expand on the two main products of non-QM for a deeper understanding of the process and what to look at on these loans. So with that, Albert, I think we're ready to roll.
Absolutely. Well, good morning, everyone. Thank you again for attending another webinar here with Home Express. So today we're going to be going over a deep dive into income and DSCR calculations. Again, we want to help you get your loan smooth in through the process here at Home Express Mortgage. So as always, we want to thank you for your participation. Here's some of the items that we're going to be covering with you today. And we want to definitely expand and touch on self-employed and touch on as well as our business customers as well. So with us today is Mr. David Grider, who's our Senior Vice President of Wholesale Lending, myself, Albert Martinez, who is your corporate trainer here at Home Express. And with us, we have today Mr. Rob Anderson, who is one of our top regional sales managers here at the company. And with that, I'd like to hand it off to you, Mr. Grider.
Uh, Thanks, Albert. As we know, this week is leading up to Sunday, right? And everybody knows what Sunday is, right? Maybe we could have a poll question come out for this weekend. What do you think?
Mr. Grider, I know how much you love. I know how much you
I
love
love the
polls.
polls,
So
right?
let's go ahead and let's ask the masses and see what they think. Right. So here we go. So who do you think will win the Super Bowl this weekend? Is it going to be the Chiefs? Is it going to be the Eagles or the refs?
I like it. That comes up a lot. That's a lot of talk and chatter about the refs with the Chiefs, right? But again, with a lot of family members living in Pennsylvania, I'm going to go with the Eagles, right? So that'd be my vote, right? So three-peat's hard, even though they seem to at the end. I mean, their defense steps up at the end with the Chiefs, and they got a great quarterback at the end. So it's going to be interesting. I think it's going to be 50-50.
Yeah, I mean the Eagles definitely have they have a good quarterback with Hurts, and then Saquon is just he's in a tear this year. He's
But
just
they're just
that
tearing it
good.
up this
He's
year.
tearing it up. So all right, let's go ahead and let's see what the masses think. And the Eagles is what
Wow.
everyone thinks. Wow.
Wow. Wow.
Okay.
Okay. All right. All right. The refs got a few votes too, right? So that's awesome. So thank you guys. That's a little bit of color there. As we start this, we'll go into the two main products at non-QM. So when we kind of go like deeper dive of that, this is still a high level. And I want to kind of touch on that just a little bit. Even account executives come over here and they're already kind of well versed in non-QM and those type of things. We still put them through 2 weeks of training before they're out in the field, because if we went into a real, everything that you could do on qualifying a borrower, it would take all day. And I try to keep these webinars to 20 minutes or so, and then 10 minutes with question and answer. Please put them in the chat. They can be on anything, not just these two programs or content we have. Anything you have questions on in our industry or on other programs, please let us know and put them in the chat, and I'll try to address those at the end. So the two main products at non-QM we talked about, and the advancement of that population, which we've seen going in the last couple years, and even more so this year, is the self-employed borrower. And that includes those who might be W-2'd or with side hustles. We've seen a lot of that coming on where they might need that business income on that. So we're going to take a look at the self-employed borrowers, the bank statement programs, how the process kind of works, and some of the options, and look at some other ways to qualify as self-employed. Then we're going to go into our investor programs, and we're going to look at how those are calculated both on long-term rents and short-term rents. So with that, we're going to go to the bank account types and kind of cover both of these with you. First one is fairly simple. It's our personal accounts, right? And what we mean by personal accounts is that the business expenses are paid out of their business account, right? So if I look at the accounting methods, I have a degree in accounting, and when you kind of go through the first accounting 101 or how to set up a business, and this is kind of what they teach you, right? Is that you set up a business, you have a business account, and you deposit all your gross receipts from sales into there, then you pay all your expenses, whatever for inventory, marketing, salaries, and at the end of the month, you have your profit. Now, that profit out of your business, you can transfer over to your personal, you can write yourself a check, you can do all these different things in your personal account. That's what I mean by personal. When we take 100% of the qualified deposits in your personal, we just ask that you supply 2 months of the business account where they show the business expenses being paid out of there, right? It's not it's the one thing I caution sometimes I get them because there's a lot of businesses out there, they deposit their business account into a personal account. If the expenses aren't paid, are paid through the personal account, that is really their business account in usage. So we look at the use of the account more than what the name is on the top, if it's in their name and how they're doing things. But that's kind of uncommon. We still get 5 to 10% of those coming in out of the self-employed borrowers. The most common is 12 months business bank statements. And the main reason is that through time, everybody's got their own accounting methods. And a lot of self-employed borrowers pay bills, their personal bills out of their business. And you kind of look at all this and going, man, I think they're just for convenience, and that if they if they transfer that money out of their business account into their personal, might be a tax event. And so there's some theory for retained earnings and those type of things that they have in there. So typically we just want your last 12 months bank statements. We have a self-employed questionnaire that we need because we got to understand we're very common sense approach to this, and we need that to kind of do an appropriate common sense method to the expense factor. The good news is that we do those calculations for you, right? So you're going to have access to a portal which will kind of show you that where you can upload right here the business account for the last 12 months, right? You kind of just put a little data, and you can just drag over the bank statements or do that. And I recommend you to don't email bank statements all over the place. I mean, security is and data security is very important in today's thing. So you don't want to do private information to have an email. That's why we have a secure portal for you where you can upload those. And when you upload all these with the self-employed questionnaire, which we'll show you, hit submit. Instantaneously goes to our underwriting department to calculate the income for you. And then typically within 4 hours, even though we say it's a 24-hour turn time, they're on it. They're going to give you what income they need to use and any notes down below that you need to look at. And you'll kind of go over that with your highly trained account executive. So with that, we'll go to the next slide and kind of look at the expense factors that what I call common sense, and they go from 15 to 90, right? Never goes 90. That's a heavy expense factor. Is it really? And I've seen a lot of businesses coming in. They're manufacturing multiple locations, 500 employees, and their gross receipts a month are 5 to 10 million. That's probably appropriate, right? And likewise, you have a self-employed borrower that's in the IT field that does 1099 with various different companies or something like that, but he works from home, doesn't have employees, limited marketing expenses, or that'd be more 15%. Then you have some stuff in the middle here, right, where you might have limited employees or that, so it's 30, 50, 70, very common sense approach to it. And you can make your case on that. That's why you kind of do the self-employed questionnaire. You give it to account executive. We think it's about here. Great. But most of these really go through really smoothly with a common sense approach on the expense factor. With that, we'll go to the next slide and kind of show you what the self-employed questionnaire looks like, right? And then this kind of, you could fill it out for the borrower through a conversation. Just put down that you filled it out, but you can look up, Google it, and you're talking to the borrower anyway. Take an application. You're trying to find out, what kind of business you run, right? And I believe in relationships. So if you get an application for borrower self-employed, you're probably doing business with them. We covered that a little bit. Where do you find self-employed borrowers? You have several of them that you deal with daily or weekly or monthly, and they have other people you know, right? So some of the things that you look for is how long the borrower been self-employed, right? To know what program you fit in. You can also look for any SFs, right? But we'll show you that where the underwriter actually puts those. And you kind of decide maybe needs a tax per letter or availability for one. All this is available for you on the XConnect broker portal. And so all this data is for you. So if you need any help with that, you don't have to be approved with us yet to get this documents and the use of the portal. Just let us know. We can set you up with credentials so you can start seeing how that works and go through this process. Let's take a look at an underwriter worksheet that they send out to you and to the AE, so you guys can discuss it, right? So you see this, it kind of is done. Over the far right, it's going to show you what the income we can use, right? So it goes through each month, the gross deposits, transfers, any of that, all the way down to the NSFs and the qualified deposits, right? But you got to pay attention also to the notes, right? They'll say, hey, this deposit looks out of the ordinary large. You look at maybe it's 100,000 deposit, but all the rest are 20 for a month. They're probably going to ask some questions. I need to clarify that, maybe get some other documentation to shore that up, that is actual business revenue, not loan proceeds or those type of things, right? So that's kind of what that looks like. And you can review that. And most of the time they go through smooth just by the numbers right there. So I'm just kind of put a heads up that the AE will review this with you, and you can always contact us to let us if you have questions on it. So we'll go to the next slide here and talk about taxpayer expense letters, right? And you say, why do you have this if you guys got a common sense approach to the expense factors, right? Standard expense factors. Well, we do know that each business, even in the same category, are run differently, right? A business owner may be more involved and has less employees than other people. Maybe that this business owner spends more on marketing, where the other company may have that already clientele built up. So the expenses can vary even with a business. So if you need that, you can actually get a tax preparer letter for you. And it kind of always kind of do this. If you have it and you're going to get one, make sure you knock out any conditions that will be on the loan, right? Let's say it's a purchase and they're going to use business funds, and the condition says they got to be 2 years self-employed. You can put all that in there, right? So the taxpayer can fill that all out and say, hey, I reviewed the last 2 years tax returns, and the average expense factor is 32.5%. They've been self-employed for 3 years, and business use of funds for down payment will not affect business operations in the future. You're done, right? You knocked out 3 conditions with one form. I'm just saying, I always try to do that to a little advantage for you so you can make your loan go through smoother and without asking, going back and forth on it. So with that, I think we'll go over to Rob here and a little bit, throw some examples. But I talked about expanded programs just briefly, right? We have borrowers that own 3 or 4 businesses. We're okay with that, right? You can upload 4 sets of business bank statements, right? And you can use income and all. We have a cash flow program. I think Rob might have an example of that, where you don't have to have 2 years self-employment. You got to have at least one, but you have to be a professional manager type of position, like business, that now you're in self-employed. P&L programs, 1099 are big now. There's even 1099 full doc. The one that kind of stood out to me, Rob, was gratuity earners, right? I think the new administration that came in kind of did that. They said, hey, no tax on tips. All right, now they're going to be depositing in their personal account, right? So you just take your blackjack dealer in Las Vegas, right? He's W-2, got his paycheck stub, and then he deposits tips on Monday. We can use those tips as income. Just get the last 12 months, you look at regular deposits, boom, you can use that. You can combine W-2 and self-employed. You can combine our asset assist program with self-employed. I'm just saying, there's lots of options. So when you send it to us, we're going to go through all this because we're here to close your loan. So with that, Rob, I'll hand it over to you to go through some examples.
Great. Great. Yeah, I'm really excited about this year. It's hard to believe we're almost 10 years into this, Dave. Can you believe
I
that?
know.
We've been
Yeah,
doing
10
this 10
years,
years.
right?
But anyway, one great example that recently closed, I think last month, we had a borrower, great credit, low LTV. He went to the bank to try and get some cash out to reinvest into some investment properties. Bank looked at his tax returns, didn't qualify, DTI was too high. So loan officer submitted the bank statements to us. Our team took a look at it. We got his DTI down to 16% based on the cash flow of the business. Just perfect borrower. We were able to get the cash out he needed. Now he went out and purchased a couple investment properties. He's got additional cash flow from those. Great way to help borrowers pull that cash out when they need it. Not just purchases, but there are cash out deals out there too. Then I had another example.
There,
Albert.
there you go.
So this one came in on our CoreX program, a little bit more flexible program. The reason it came to us is because it got turned down by another lender because they thought his deposits were inconsistent. But when we looked at it, he's a real estate investor and property flipper. So our highly trained AE said, why don't we take a look at the 24 months bank statements instead of the 12? We were able to take a look at that, do a make sense calculation and averaged his income over 24 months for consistency. His family now has the dream home they've been looking for because we found a way to work around by using the 24-month bank statements. So make sure you're talking to your AEs on each deal to have them help you structure it the best way to get them approved.
Great. Thanks, Rob.
Yeah, no problem.
That's kind of a higher view of our self-employed borrowers using bank statements and some other methods on it. So there's some great examples. Now we're going to go into investor cash flow, Albert. I think we should have another poll here, right?
Mr. Grider, I know how you like those polls.
I do.
Before we start talking about, investor cash flow and business purpose, how about we ask the masses what they think about, what percentage of the non-QM market is business purpose? What say you? Okay, we got.
I don't know. This is a interesting one, right? So, and then my webinar last month, we kind of had this chart, right? Of like, we know the self-employed group is growing, right? With the side hustles and people moving out and trying to figure out what they needed to do with the economy and inflation. Then I looked at the small to medium investor growth over the last 2-3 years. Tremendous growth in that.
Absolutely. So it looks like the masses have spoken, and but they think it's 60%, Mr. Grider. What say you?
I think they're very accurate. I think it's in the 60% range. I know we just look at our numbers. I think of the units that come in, that's about right. 60% of the units, right? Dollar volume wise, it might be 50-50, right? Because usually the primary consumer purpose loan, they're a little bit larger versus the cash flow program on the non-owner occupied. So let's go ahead and look at the investor cash flow. I like the word cash flow because that's really what it is, right? So a DSCR, kind of know what that is. There's so many presentations on it. Hopefully everybody's been doing it, but those haven't. This is just a quick, just a little bit of information for you, kind of what it is. And those that don't, please reach out to us, and hopefully this helps you out a little bit. It just stands for debt service coverage ratio. So our borrowers on this program, it's not a DTI loan. Okay, this is for business purpose of a non-owner occupied property. We qualify based on the credit profile of the borrower, right? And the cash flow of the property, right? So on a purchase, we're going to use the 1007 or 1025 if it's units, right? That's your rent survey. And that's how those calculations are done. So when you look at it, it is, your gross receipts from that property, right? What's the long-term rents on this particular example, or short-term rents, and that on that calculation divided by your PITIA, and that will get you your ratio. On a refinance, we can do either or. You can use the market rents from 1007 or 25 or actual rents, right? We do caution you, always put it in a cash out, must be used for business purpose. We do have a program for borrowers that want cash out on their investment property for consumer purpose or for personal use, maybe it's a down payment on a new primary, but that is a TRID loan. It must have to go that direction. We do have that program for you. Property types, 1 to 4 units and short-term rentals. We actually do rules, condo tells, all kinds of different things on this. So this is just kind of an example for you. So the main thing I was on the calculations are different on long-term rents versus short-term rents. Short-term rents, and I got these need to be in a higher density areas where short-term rents are acceptable. And those are usually resort areas, whether it's skiing in the winter, beaches in the summer. You kind of know what it is, a very common sense approach, so you can get the right calculations and the right data for the use of that. But we do take a 20% expense vacancy factor on that short-term rent. So, you take the average of 12 months, maybe there's air DNA on it. There's all kinds of different things, ways you can do that to get that number, but it's an average of the last 12 months. And then it's 80% of that is how you then calculate your DSCR calculation. So we'll go to the next slide. And a little bit more of the math behind it. So it goes on there, the long-term rents and the short-term rents. Kind of show you that right there. So if it's a refinance, you use last 12-month average, you can get a printout from Airbnb, Verbo, bank statements. But we're just trying to get the average because you know that on the short-term rents, it's higher in that peak season time, right? You go peak seasons. I wonder if how many Airbnbs are being done on the Super Bowl this year, right? So you see a lot of that, but then it goes way down, and you can't really use the high point of it because they own the property so you need an average. Also for the beaches, they go for more in the summer and then less in the winter, likewise in the ski resorts. So that's why you use a 12-month average. And the difference between the two is in short-term rents, usually utilities are still in the owner's name, right? They have a lot more upkeep in making sure that it gets serviced properly after someone departs the rental and comes back in after 3 to 5 days or week, whatever their setup is. And with the DS on the long-term rents, usually utilities are in the tenant's name and they're keeping up with the upkeep. That's kind of the difference between the two. Kind of a common sense approach, right? We do have programs, though. If you go below DSCR of 1, we actually have it even below 0.75. Haven't seen too many of those, though, right? Some highlights of the program. And again, probably you guys sitting around can remember back, maybe 4 or 5 years ago. And if they own more than 10 properties, what do? Right? Oh, I can't get it done. No, you can't. It's unlimited properties that they own we can do. We can actually do up to 10 loans to the same borrower at one time, up to a 4 million aggregate. These are non-TRID, so they close fast. We do send out terms of the loan. We don't want any surprises at them. We believe in full disclosure, so it's kind of a slimmed down LE, but there's no CD sent. You can order appraisal anytime. We allow dual comp. That means borrower paid and lender paid. Again, if you can go up to 5, but there's competitive nature on it, so I don't see that often. But you do have the ability to combine those. Again, we talked about the cash proceeds. DSCR is down to 0.75 below. To get in, we need a 620 score. We do have the ability here, and it's pretty quick with us if they want to invest in a business entity. And we see that quite a bit. So most more sophisticated, medium investors like to have each property in an LLC, just in case there's something happens to the property, with the tenants or something, or a slip and fall out front by neighbor, that it protects them from their personal liability. There are also a lot of states, right, that have you don't have to be NMLS licensed in to sell this product, right? I've had a lot of broker partners put in marketing and all these different things, and maybe they're in California, but they're marketing in Texas, right, or in some of the southern states. So everything that's black, you don't need to have an NMLS requirement for doing business purpose. So that kind of opens up, right, where you can get loans from. So with that, we'll go to Rob again, see some examples he has from his region, and kind of talk a little about what he's seeing out there in the investment world.
Great. Yeah, these provide a great opportunity to build your pipeline, especially with those states that don't require a license. One of them is Hawaii, a great area for vacation rentals. Had a group of friends that were wanting to purchase a short-term rental in Hawaii to make additional income, and who knows, maybe they'll go visit, take a week there themselves. They pulled an Air DNA, which we will use on purchases. It's a database for short-term rental income, but the air DNA came in low. So this was one time where we could actually go full doc. One of the borrowers had a great year in business, so we did a 1 year full doc. They were able to purchase that short-term rental in beautiful Hawaii, and now they have a property that they're cash flowing on and maybe take a vacation once in a while in their own property. So great
Yeah,
deal.
yeah, it's a great deal. With the rain I have in Northern California, I want to go to Hawaii. So maybe they have
Exactly.
an opening for me, right? So
Yeah.
that's awesome.
Yeah. Then I
All
had
right.
another one here. This was a huge home in Malibu that unfortunately was affected by the Malibu fires a few years back. Unfortunately, that's happening again in Los Angeles. But this borrower went out, took out some hard money loans to rebuild it. It was a rental property. Hard to believe. He must rent it to the rich and famous. But we were able to take it. We got a small loan amount exception for him because it was such a low LTV. The DSCR was 2, so great comp factors on this one. Uh, no one else was touching it just because of the loan amount. We decided to do a make sense exception, and we were able to provide the borrower with the funds to pay off these high interest hard money loans. So it was a great
So
deal.
this was
Borrower's happy.
the Malibu fires from a few years ago. Then they rebuilt it, and we were the takeout. Plus, you got cash out after a couple years. Awesome, awesome. That's helping out
Yeah.
some people. I love it.
Oh yeah. Yeah, we love helping borrowers and we love helping our loan officers get more business.
It's great. Okay, we're about 20 minutes in, Albert. I think we can hopefully have some questions here from the chat, and love to take those.
Absolutely, Mr. Greider. Yeah, we have some questions coming in through the chat. So we have one from Tyrone, and he is asking, what if the taxes are not done by a CPA or tax preparer?
And I'm going to reference this to expense factor letter, right?
Yes.
Now, the makes sense to be, hey, you got tax returns where they're self-done, right? Okay, they're self-done tax returns. I still need a third party to review those and provide that. So you'd have to get a tax preparer to review the tax returns and provide that letter, right? That they reviewed the tax returns to get to use the expense factor that you're requesting. So if they don't have one, again, non-QM through Dodd-Frank, there's a lot of different rules with it, right? So you can't just have a state like the stated business owner, hey, my expense factor is 80, we just take that. It's all built on documentation or by third parties, right? So the third party on gross receipts is the actual bank. We're actually saying they're depositing receipts into a bank. Okay, I got the third party being the bank on those. Now, if I go out and say what's the appropriate expense factor, we have a common sense approach. Here it is, 15 to 90. Let's say, hey, I need something different, but the guy doesn't have a tax account. Well, unfortunately, they're going to have to go get one and say, hey, here's my tax return 2 years. Can you provide me a tax accountant letter and state that you reviewed the tax returns for the last 2 years?
Awesome. Thank you for that, Mr. Greider. We have another question from Jose Sanabria, and he said, hello, for someone to do this DSCR program, do they have to own a home before they buy with the DSCR program?
Great question. This comes up. So the short answer is no, but again, it's a make sense deal, right? So I look at it this way. Maybe I have a doctor in San Francisco, so to speak, right? Doctor doesn't want to buy there, it's the property. He's got, 2, 3 years of residency with the company there. He's got his assets going up and he goes, man, I don't own, but I rent, but I would like to get in, diversify a little bit and get a rental property in Sacramento. Okay, it's close by, a little bit cheaper. Okay, great. That probably would work. What we tend to see is that, hey, it's just a program to circumvent TRID or DTI. That's what you don't want. So if it's someone, hey, my first home is going to be a rental and it's 3 miles from where I work and live presently, that's a little tougher, right? Again, these got to be non-owner occupied and make sense. So if you have a make sense deal, love to look at it. So we don't eliminate it because there are make sense deals that where that could be appropriate.
Awesome. Thank you for that. Maruz is asking, can you please email me the slides to keep my knowledge base? And then Maruz put in their email address. So yes, we do provide a copy of the slides. It gets mailed out to everyone that registers. In addition to that, they're also the webinars are not only posted in our YouTube channel, which you should definitely subscribe to. We're always posting our updates that we do on XConnect. We have it. We post tutorials to show you how to utilize our portal, whether it be you want to submit bank statements for review, how to utilize the features, and we do have some more exciting stuff coming up. So yes, Maruz, we'll definitely make a copy of this deck available to you for your records. And as always, you can always reach out to your assigned account executive, who'll be more than glad to go over things with you as well.
Yep.
Next question that we have, it's from Ron, and it says, I have a borrower that had to close with private money, hard money, to help the seller quick. Now I have to do a DSCR loan for the long term. Any seasoning issue there? Question mark.
That's a great question. Okay, so I'm glad this came up, right? So the seasoning. So I'll go with our general guidelines, right? And so when I say general, we're a true lender. That means we write our own guidelines. We fund with our own money. That's why we want to see those common sense deals come in. So generally, the guideline on seasoning is if they purchase the property in the last 6 months, the value we'll give it for lendable value would be the purchase price plus documented improvements they made, right? So it's not an issue of us doing the loan at a certain time. You don't have to wait time. It's really a question of what value we can use for it in lendable terms, right? It could be worth a lot more. Who knows it is. That's really it. So the days of seasoning is not really a factor of us looking at the loan. It's a factor of what value and what LTV we can go. So we'd love to take a look at that, right? So I've seen a lot of deals where they get into a deal for private money because they had to go quicker. Even though we're pretty quick, right? But maybe the property is not lendable now. They have to fix up, do certain things, so you wouldn't have a subject to appraisal. But it really depends on, not the days, but the valuation we can use on it, right? So hopefully that answers that question, right? So.
Awesome. Thank you for that. We have a shout out to one of our account executives, Christy DiMaggio, by Kathy. We have a question, says, how do you deal with investors who just moved to the US on investment visas and have no credit history?
Wow, great question. So it's kind of a two-part thing. They just moved to the US. Well, I don't know. Okay, so I might have a borrower. They here illegally. So first of all, our requirement is if you're here in the U.S., you got to be legally here in the U.S. and provide documentation that be the U.S. Since they live now in the U.S., that's a tough go. Without credit history, we don't have a way to do it. How do we make a credit decision with no credit? Now, I say that because we do have some other programs that are we call foreign nationals on this program, where that borrower lives and works outside the United States and is not a U.S. citizen. There's ways to get those done. But as soon as they legally or say they're coming here and you're in the United States, generally you need a couple years, right, before we could make a credit decision on those. They need to establish credit, those type of things. But our foreign national program, we have other methods that we use that we kind of require on those loans if they live and work outside the U.S. and are not U.S. citizens.
Awesome. And Omar did provide a little bit of clarity below, and he said, yes, here legally. So if the person is here legally. It looks like he added a follow-up to that and said, can this be offset by a high down payment?
No. We're a lender, but ultimately all our loans go into some type of securitization, right? So given that, there's certain things you have to look at. So that's more of a private money deal or someone that's portfolioing that particular loan. Because without a credit score, being here in the United States, that poses a problem to get any type of rating through the rating agencies to put it in a securitization pool. So that's why that one's out. And I agree, it's probably a common sense deal, but we know we can make exceptions. These are ones that we know for a fact that they're not tradable, right?
Awesome. I am getting a question from Damien, and it says, can you buy down the rate on a bank statement loan? If so, how many points can you buy?
Great question. You can go down to 98. If you look at our pricing, and I imagine you should go in there, we're going to give you a rate stack, right? So you go in there, put in your parameters of what you want to do in the loan. It gives you a rate stack, and you can go all the way down and buy that down. It's usually a 98 is where it's at. So depending on your LTV, your FICO, and what you're trying to do on the loan, it'll give you a rate stack. And if it sees 98, then you know that's 2 points down. But I think it'd be on your particular scenario, right? And we're not going to do any high cost loans, so that might also preclude you, right? So you kind of have to play with it, make sure it passes high cost.
Awesome. Thank you for that, Mr. Greider. The next question is, can we do a rapid rescore under these programs?
Absolutely. Now, I say this, the thing is, just make sure it makes sense, right? Errors, that kind of stuff. But yeah, you submit a loan, something happened, some error, medical bill, whatever it is. Hey, we're going to get removed and resend it in. We're just looking for accurate, right? If it's accurate, it's accurate. We want the most accurate data. If the new rescores is the best accurate data, we're going to use that.
Awesome. Next question. So if someone wanted to buy a small hotel, are those programs available for clients?
Okay, they aren't here. We're in the residential sector, so that's 1 to 4 units. So as soon as you get into hotel, that's into commercial. And so if you're looking, there are commercial lenders that will do those, but we're sticking to the residential sector, even on the business purpose.
Awesome. Thank you for that. Maruz again wants to know what's the YouTube channel? Home Express. Yes, so Home Express does have a YouTube channel. Literally, if you go to YouTube and you just put it in the search, Home Express Mortgage, our YouTube channel will come up. You can subscribe to it. That way you'll receive notifications whenever a new video is posted, just like this webinar will be posted, as well as on our website, which you can always go to homeexpressmortgage.com, and our webinars are also posted on there as well. Looks like I'm having a little bit of mic issues, so sorry about that. I'll work on that for the next one. Question from Maruz. How about the borrower here for less than 1 year? And regarding DSCR loan, since we're not using their income and only their credit, are we good to go?
You're still going to have the credit issue and housing issue, right? Where do they live? These type of things you really need to discuss with your account executive. I'm not saying no to it, but you got some challenges on that. So I just came to the United States less than a year, and I'm buying a whole bunch of investment properties. That's her question. Well, okay. How, right? Hey, left there, took all their money to the United States, set up a business. I still got a problem probably on credit, right? How do I know how they're going to pay their housing payment? Right? I mean, that's what it's about, right? It's like, hey, you pay your housing payment on time. We want to try to lend you some money on this for what your needs are, right? Whether it's cash out on a bank statement deal for college tuition, right? Trust me, I know on that one, right? To do college tuition comes up, right? Or to purchase investment property. No matter what, we need to ascertain what is the credit of this loan and make sure it's an appropriate risk. And again, that's not just for us, it's for them too. We don't want to put a borrower in a bad situation where, hey, I'm buying all these rental properties, highly leveraged, and they're doing it in areas maybe declining market. We got to have a conscience out there, right? That's what I call it. It's like we do good loans to good people who traditionally don't get done through the agency world. And that kind of leads me up to our webinar next month, right? That we're going to take a look at. Got some other channels for you that I call it hybrid that are coming out. One is we're going into the correspondent channel. So if you want the correspondent non-QM, please talk to your broker, or if you're on the phone, reach out to me. We can get you on the list there on the correspondent non-delegated. Still get the same service, same exceptions, the same make sense type of deal, but that might be an avenue for you. The other thing we're coming out with is prime jumbo AUS and a non-owner AUS program. I call it a hybrid because it fits the securities market in the residential, but it's differently priced than your agency, a lot better priced. And so we're coming out with those, which I'll cover next month. So with that, Albert, I don't know if
Yeah,
there's anything else or.
yeah, we do have some more questions popping in, so that's pretty good. We're getting a lot of traction. So, can you explain the difference between business versus personal purpose for a DSCR cash out loan requirement?
Okay, so if you're going DSCR, I don't need to see any bank statements. That's a debt service coverage ratio. That's off the cash flow of the property and the credit profile of the borrower. That's it. That's your qualification. So you're not even bringing in bank statements. If you're going to go a method of DTI, then which is a little bit lower rate, but kind of make sure that it qualifies that way, right? That's why you want to send them into the underwriter first and know what direction you go if you want to go that direction, right? So the difference between a personal and business, right, is the usage of the account, not necessarily the name. So it's easier on business accounts because they'll have the name of the business generally, just the name of the business. Okay, we know that's a business account. Where it gets a little more where you have to really look at the usage is on the personal account. Okay, they're self-employed and they're providing personal bank statements. Okay, yeah, for the bank concern, they're personal. For the usage of DTI, I got to ascertain, are these being used as business or are they being used for personal? So it's the usage of the account, and how we differentiate that is by providing the 2 months business bank statements, right? That proves that their expenses are paid out of that. So let's say they don't have that. We just take your personal bank statements and we treat them as business usage and we apply expense factor to it. So that's really it. So the business could actually be used as the personal could be used as business, but we're going to apply an expense factor to those personal. So it doesn't preclude the loan being done. It's just you just got to make sure we're applying expenses to those personal bank statements because their usage is as a business.
Awesome. So Maurice wanted to add some follow up, and he wanted to know, so if they do not own a primary residence, they cannot buy a rental property? And
No, you can't.
they
You
can.
can't.
Yes.
I just caution you on to make sense. Yeah, it should clearly be a non-owner they're buying. That's all I'm saying.
Okay, perfect. Uh, we have another question here. How long can we refinance if the property has been taken out of the market? Borrower had it for sale, but took it off the market and would like to know if we can refinance right away, or do they need to wait?
No, not really. We probably need a motivation letter, the cancellation of the listing. Here's the deal. It's not the ability to use it. I'm just going to tell you what some of the things you need to consider when you're dealing with that borrower. One is, what was the list price? What was the last list price, the lowest list price? Not going to get a lendable value over that. Typically, it might be a little bit lower than that. So just kind of throw that out there, right? And then we do require a 2-year prepayment penalty, right, on the recently listed. We can't have, we're not a bridge loan company, right? So we do loans, hopefully they stay on the books for a year, 2 years, right? We understand that, if they can get into, agency deal or come back to us with our agency program, great, they get a better loan. But we're not going to do it, hey, they got the cash out, and then it's relisted the next week. You know, uh, that could happen, and we have to avoid that.
Awesome. Thank you for that. We have one final question here, and it says, is there a no ratio option available with the DSCR program? If so, what is the max LTV for purchase, rate and term refi, or a cash out?
Wow, that's a great question. The answer is yes. We do have a no ratio option, so that's below 0.75. I don't see it very often, but there's areas where there could be individuals or those type of things, even if they're doing LLC, where they might want to buy properties for investment where the cash flow is not quite there. In other words, high net worth people, they know they want to buy a house. I always use the example of, I'll just take my doctor in San Francisco, actually owns a house there in San Francisco. He's got 4 years left, but he found the house that he loves in Lake Havasu, Arizona, let's say, right? he knows that this $3 million house is not going to debt service and long-term rents, but he wants it. He can afford it. And he goes, hey, I know it's not going to debt service. I'm fine with that. I want this house. Plus, I'm going to do upgrades to it when I retire in 4 years, and they do it. Okay, that makes sense, right? Okay, great. He's putting 25% down, all that stuff. Great borrower, right? So that's your no ratio program, right? So yes, we do them, right? And so what's the max on a purchase? I think it's 75 and it's either 60 or 65. The good news, I think we have on our deck here a program guide, right? So, which will kind of go through that. And it's actually in the price. So it's also going to depend on the FICO score and that, and the qualification on it.
Right here's the program guide, Mr. Greider.
Yes, yeah, program guide. This is in your deck. You're going to get it. So just a quick program guide. And you can also use a portal. Say, hey, I got a borrower here. It's not going to ratio. Let's see what the program is. You can plug it in and tell you what we can do. And you can contact your highly trained account executive. They're going to let you know what fits. But that is an option.
Awesome. Thank you for that, Mr. Greider. I think that closes out the questions. If you want to go ahead and close it out, Mr. Greider.
Hey, thank you, everybody, for joining. We'll continue these on throughout the year, kind of went over the next content, but we appreciate doing business with us. And if you haven't done business with us, please reach out to us. You'll be really surprised of how involved we are in trying to get your loan closed and trying to figure out a way. So there's a lot of deals in non-QM that are a little bit different, have different twists to it. You know, we know the ones that come in. It's an easy one, 12-month business bank statements, whatever it qualifies to purchase. Great. We want all those deals too, but also want to take a look at the deals you might be struggling with. Give us a call. I bet you we can figure out a deal, a way to make those deals work for you. And we want to help you close more loans this year. So thank you again for your support, and reach out to me. You know, on this deck, you have my email, my phone number, and I'd love to hear from you.
Awesome. Thank you for your time. Bye, everybody.